Good afternoon. It is Wednesday, January 31st, 3:20 p.m. Markets have 40 minutes to close, people. So much to talk about, so much going on. I want to talk about, first of all, last night's State of the Union address. President Trump, he talked about a lot of different things: economic policy, foreign policy, including infrastructure. Now, when he first started, made a proposal for infrastructure, he wanted $1 trillion spent on infrastructure. Then last night he said in his speech at least $1.5 trillion. So he's up the ante by a $500 billion. Very interesting. Just more and more debt. And what I'd like to say is not so much what he did talk about, but what he didn't talk about, and that's the debt. Not one word about the $20 trillion debt was mentioned. I find that very telling, to say the least. So he's speaking what he is saying, what he's not saying. And then today, we had the FOMC meeting. This was Janet Yellen's last FOMC meeting. The baton will be tossed to Jerome Powell. She took her victory lap, okay? And a lot of, there was a lot of reaction in the markets to this meeting, which I'm frankly very surprised about. Federal Reserve press release. Information received since the FOMC committee met in December indicates that the labor market has continued to strengthen and that economic activity has been rising at a solid rate. Gains in employment, household spending, and business fixed investment have been solid, and the unemployment rate has stayed low. On a 12-month basis, both overall inflation and inflation for items other than food and energy have continued to run below 2%, right? They can't meet that inflation target. Market-based measures of inflation compensation have increased in recent months, but remain low. Survey-based measures of longer-term inflation expectations are little changed on balance. Nothing has changed. Consistent with its statutory mandate, the committee seeks to foster maximum employment and price stability. That's their dual mandate. The committee expects that with further gradual adjustments in the stance of monetary policy, further gradual, however they define gradual, okay? What's gradual? I don't know. Very ambiguous. With further gradual adjustments in the stance of monetary policy, economic activity will expand at a moderate pace, and labor market conditions will remain strong. Inflation on a 12-month basis is expected to move up this year. Inflation is expected to move up over the next 12 months, and to stabilize around the committee's 2% objective over the medium term. I have to laugh at that statement, but that's not really what I talk about. They're saying inflation is going to rise over 12 months, and it's going to get right to that 2%. Okay, what do they got, a crystal ball? They've been wrong so far on everything, okay? So we're to believe now that they're going to get it right. What a farce this is. This is such nonsense. Near-term risks to the economic outlook appear roughly balanced. There's a balance, 50-50. It can go down, it can go up, we don't know, and they get paid for this. That's what's so incredible. It's balanced. It could go either way. What do we know? But the committee is monitoring inflation developments closely, so they're watching it, okay? What do you think we do here all day? Remember in The Big Short, right? Did you check the loan level data? What do you think we do here all day? Well, what does the Fed do? They monitor. They watch. That's what they do. In view of realized and expected labor market conditions and inflation, the committee decided to maintain the target range for the federal funds rate at 1.25% to 1.5%. There was no change. Nobody was expecting a change in this meeting. Okay? She's not going to raise rates on her last meeting, so nobody was expecting a change. They didn't do a change. There was no surprises here. The stance on monetary policy remains accommodative, thereby supporting strong labor market conditions and a sustained return to 2% inflation. We're being accommodative. We want to get inflation going. We want to get to our 2% target. So how on earth could I see all these headlines, gold is selling off because of hawkish Fed? Where are they getting this from? Where are they getting this? The FOMC policy meeting deemed to be hawkish. What are they reading? What am I missing here? They didn't change rates. They're saying it's accommodative, and they want inflation. Okay? They're trying to get inflation. How on earth is that negative for gold? Explain it to me. In determining the timing and size of future adjustments to the target range for the federal funds rate, the committee will assess realized and expected economic conditions relative to its objectives of maximum employment and 2% inflation. This assessment will take into account a wide range of information, including measures of labor market condition, indicators of inflation pressures and inflation expectations, and readings on financial and international developments. The committee will carefully monitor actual and expected inflation developments relative to its symmetric inflation goal. Basically, that's it. The committee expects the economic conditions will evolve in a manner that will warrant further gradual increases in the federal funds rate. It will warrant further gradual increases. 1 this year, 2 this year, 3. How do you define gradual? Nothing has changed here. I don't read anything in this statement, okay, that you could walk away and say, they're hawks. There are no hawks at the Fed anymore. There's doves and there's uber doves, right? The federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. Let me read that again for these people that are putting out these headlines how this is hawkish. The federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. However, the actual path of the federal funds rate will depend on the economic outlook as informed by incoming data. So there it is again. They're data dependent. Okay? We have our models. They're wrong. And as data comes in, we'll adjust our models. Okay? So, once again, they're talking out of both sides of their mouth. Okay? So that was the press release. Now, things moved on this press release. That's for sure. Okay? The 10-year hit 2.75. Okay? The dollar, which had been down, rallied, okay, and turned positive. The stock market, the Dow Jones was up about 250 points. Oh, it opened up about 250 points thanks to Boeing, right? Which is like half the Dow, okay? And it all came down. 10-year yield rises to 2.75. After Fed says inflation will move higher. Inflation will move higher, okay? Yet there are so many people out there that they're still drinking the Kool-Aid how somehow this is negative for gold. Okay? They're playing checkers, okay? Well, if inflation is moving higher, the Fed will raise rates, and that's stronger for the dollar, and that's negative for gold. No, no, no. Okay, let's play chess. If inflation is going to get higher, and it already is higher, and we all know that, okay, that means the dollar is getting weaker, okay, which is good for gold. They want to get more interest rates because they want to be compensated more for a weakening dollar. It's just that simple. I have this debate with my friend all the time, and he just doesn't get it. When are these people going to finally get it? The U.S. government debt yields rose Wednesday as the U.S. Federal Reserve left rates unchanged but said inflation would move higher this year. The yield on the benchmark 10-year Treasury note rose to 2.75% at 2:23 p.m. Now this release that I read to you, 2 p.m., right? So shortly after the 10-year spiked, right, 2.75, while the yield on the 30-year hovered around 2.97 flatline. Bond yields move inversely to prices. The Federal Open Market Committee concluded its two-day monetary policy on Wednesday. The Federal Reserve did not make any changes to its policy stance, though the central bank indicated that it anticipates inflation to heat up as the year progresses. Well, this is true. If they finally get something right, okay, then gold's going to take off. They're not going to be able to fight it. They can't. Somebody asked a great question the other day. Right? I think it was just last night. You know, how many rate hikes, you know, can you anticipate this year? Will 4 rate hikes crash the market? The only reason they're raising rates now is so they could have a cushion so they could drop them when the next recession comes. It's just that simple. Okay? What's the straw that breaks the camel's back? If you look at the market today, you'd think it was now. But yet they're shills and cheerleaders on CNBC. They want to convince us that this has nothing to do with what happened with these rates. Well, it's the end of the month. It's rebalancing. Pension funds have to rebalancing. We had such a great January that we need to rebalance. And now we'll have a great February. That's all it is. According to December estimates, officials expect 3 rate hikes. And I say I could see 2, I could see 3. I mean, what did they do this year? They did 3. Maybe they'll do 3 again. Okay? They'll push the envelope. All right? If the stock market cries, you know, they'll have to stop or let it tank. According to December estimates, officials expect 3 rate hikes this year, so long as there is no significant disruption to market conditions. There you go. So it's the tail wagging the dog. There's no more free markets here. Look, the handwriting is on the wall here, people. The handwriting is clearly on the wall. All right? So I'm not going to continue to read. Well, there's some little things here. Rising interest rates were to blame for a 2% pullback in weekly mortgage applications. Okay, we talked about that the other day. Housing prices are soaring, incomes are flat, mortgage rates are going up, right? People are tapped out with savings. So now there's a pullback in mortgage applications. So now, do people want to rush in while rates are still relatively low and just buy anything? They don't want to miss out. One last final heave-ho before this whole thing crashes. So there's a lot of information. I didn't even get to really what I wanted to get into today. Okay, the ADP payroll number was 234,000 jobs. Okay. This Friday, we get the non-farm payroll. This is a big number. We have to see if they're going to use that as an excuse to whack gold like they usually do. Okay? So, let's move on. I was watching gold all day. All day. I've been watching this battle play out in real time. And I just want to share some photos with you. This was taken at 3:45 a.m. New York time. Okay? Gold was up $4.30, $13.44. Then it started to pull back. 3:45 New York time. Okay? At 8:25 New York time, it was still up $3.50. But you know, that's that time frame right there. That's when the paper gold, right? That's when the cartel hits it, right? I've shown picture after picture after picture. Right in that time, you can set your watch by it, right? 350, 1341.60. They're trying to take it below, right? Ooh, gonna have to refresh. Kind of went too far. All right, so that was 8:25. 4 minutes later, still hanging on, 1341.90. 8:29 a.m. Then at 8:48, look at that, boom. It went up this time. Back to that 1345, up 650. Gold is trying to hang on. It so wants to hang on. And these banksters are throwing everything at it. And then look what they do. This is, now that was at 8:48. At 11:54, boom, they crush it. Where did they take it? Right back to 1340.40. That's it. That's the line in the sand, people. Look at that. It couldn't get past that 1345. Had a double top there, and they whacked it again down to 230. It's a battle right here. It's playing out in real time. 1225, basically more of the same, desperately trying to hold on. Right? 1246, 1339.70. But look at that. How it's right there. Up, down. 1341. So this is what time is that? 141. Look at that. Look at that right there. Up, down, right at that 1340 level. Desperately trying to hold on. Then they finally knock it down. 1336, right? But then, look what happens. Boom, it comes back. It comes back. 1343, up $5.20, in spite of the fact that rates are rising. So when are these people going to stop drinking the Kool-Aid? When are they going to stop with these hit pieces, okay, and just look at the data? What a battle today in the gold market. You talk about being in the trenches. This is it. This is it, people. This is it. This is trench warfare. So, a few things I want to get into. I want to kind of zoom in. Now, I said yesterday, you know, I was hoping it would have been nice to get 1349 monthly close in gold. That would have been the top of monthly close going all the way back to July of 16. Doesn't look like we're going to get there. I don't know. These markets change from 1 minute to the next right now. It'll be interesting to see how the stocks close today. All right, and how gold does finish today. But I want to zoom in on this monthly again. And the first picture is, now that's, this is the monthly, okay? This is that 2009 reverse head and shoulder, right? And now this is a more zoomed in look at where we are right now. We got the left shoulder, we got this large base that's forming, okay? And this looks like a head and shoulder pattern playing out, reverse head and shoulder pattern, okay? Now, I wanted to zoom in a little more closely and look at this second one, because I think this is interesting. Now, if we zoom in closer, you see that's the same pattern, that circle, but now it's kind of stretched out, all right? Now, when we broke out of this reverse head and shoulder, it was September of 09, okay? If you could see that. And it took 24 months, just 2 years, to get to the peak. That's not a long time. It's really not, 24 months. Now, the September 2010, that's when we breached 1,300. And it was only from there 12 months to get to those all-time highs. So if we could take out this long base that's forming, this could be very, very positive for a few reasons. One, the base is much longer than this. It's much longer, which would indicate the move is going to be much more magnified. And we're starting from a higher level. Does this have to happen? No, of course not. But it's not a zero probability. There's a decent probability that it could. So this is what I'm looking at. Okay? Now, I want to show this data right here. Because September 09, right? That's this September 09. When we broke out, that's when we breached 1,000. That was a big key level. We breached 1,000. September 2009, $1,000 breach. 24 months later, we go to August 2011, top at 1831. Remember, these are closing basis, right? 80% move in 24 months from 1,000 to 1,800, right? 24 months once we breach that $1,000 level. Now, September 2010, 1309, right? You see it there? September 2010, that's there. That's when we breached 1,300. I left out the zero there. 1,300 breached. 12 months later to that August high. 38% gain. All right? I see basically the same setup. This looks like the same setup. And now when we zoom in, or actually when we pull out to this final chart, if you take that big picture, you could see why they're defending this level so much. You see that horizontal line right there? That's where we're at. That's the horizontal line. Now look at all the candlesticks. They push above the line, right? They touch the line, right? So I think that's why this is being defended so closely. I want to end with one more thing, and I think this is important. Actually, this is what I really wanted to talk about. Because, okay, we're at basically 1340. Now, my friend who owns, he's a stock guy, right? You know, we get into these debates, these discussions. A lot of it he likes to do just to get a rouse out of me, right? But now, what he does right now, he works for a market maker, right? All they focus on is US dollar, yen. Trade. That's all they trade all day. The dollar, the yen. They make a market, okay? So at best you can call them market makers. At worst, I suppose you could call them front runners. But we won't get into that. Now, so when I refer to the dollar index, the DXY, which is like 89 today, I use it. I use it all the time. I use it to base where things are going, the dollar strength, the dollar weakness, gold, right? The correlation, stocks. So I put a lot of significance into the dollar index, which is a weighted index, right? Made up of a basket of other currencies, the euro, the yen, right? The Swiss franc, so on and so forth, right? He, on the other hand, pays no attention to it and says that people who actually move money, they don't even use this index, okay? That they trade with the pairs, right? Euro, dollar, dollar, yen. That this means it's just an arbitrary number and it means nothing, okay? Now, I disagree strongly, okay? He says this is just an arbitrary number. It means nothing, right? No one who trades money, no one who moves money uses it. They don't even look at it. And he's been around. Everyone he's ever worked with, they don't even look at it. Okay. I use it. I think it's a gauge of the dollar strength. So I say all that to say this. Because right now, Gold is at 1340. The DXY is at 89, right? Now I went back, this is just a snapshot in time, okay? But when we first breached the 1300 level, okay? I went back to October 2010, November 2010, December 2010, okay? And if you look, I know the numbers are small, but if you look, let me try to show that to you if you can. If you look here, for example, October 1st, 2010, gold was 1316. The US dollar index was 78. 1313, right? October 4th, 1313. 78. 1330. 77. 1346. 77. 1345, 77, 1341, 70. What am I getting at? When gold was at 1340 here, the US dollar index was in the mid-70s. Now gold is at 1340 again, and the US dollar index is at 89. So if he's right, this means nothing. If I'm right, this means a lot. Okay? Just look at the numbers. Get the 1350s, right? 1, 77, 77, 77, 76, 77, right? 1367, 77. So it basically spent October 2010 mid-70s. 77 was 78. And gold was basically, call it 1350, 1340, right? November, the index traded between 75 and 79, 80, got up to 81, right? It got up to 81. Now, here, look at this. November 30th, the last day of November, right? Gold was 1383, and the index was 81. Okay? You could see the numbers there. See it for yourself, right? And then if we look at December, basically was 80, 79, 80 the whole month. And yet gold made a top of 1412, 1415 on December 6th. December 6th, 1415, 79 DXY, right? 1420, 79 DXY, right? So on and so forth. There we had some 80s, basically 80, right? It ended the month 1412, 79. So we're right there again, and yet the DXY is 89. If the DXY goes back to 77, okay, you could see a massive move in gold. So it looks, and this goes back, you have to say to yourself, it's all about losing purchasing power in the dollar over time. So even though this number, okay, he says it's arbitrary. All right, it's arbitrary. But if you look at it against gold and not these other floating currencies that are just floating against the dollar, that's not floating against anything, right? Because we talked about this right? On August 15th, 1971, they put an end to Bretton Woods. Nixon closed the gold window. And since then and forevermore, the U.S. dollar is not backed by anything. It's just free floating. Trump says he wants a free floating currency. Mnuchin. It is free floating. Okay? It's just floating and everything else is floating around. Nothing is attached to anything. So if you look at it compared to gold, when gold was 1340, the U.S. dollar index was 77. Well, gold's 1340 today and the U.S. dollar index is 89. A lot to think about. That's basically it, people. So one other thing I want to mention. GE. GE's getting slaughtered. Okay? Now you're hearing rumblings about they want to take it out of the Dow. Right? The Dow Jones Industrial Average was created in 1896 by Charles Dow and originally consisted of 12 companies. 1896 wasn't the Dow 30, it was Dow 12. American Cotton Oil, American Sugar, American Tobacco, Chicago Gas, distilling and cattle feeding, General Electric, GE. Lastlead Gas, National Lead, North American, Tennessee Coal and Iron, U.S. Leather, PFD, and U.S. Rubber. At the time, these companies represented each sector of the market, and thus the Dow Jones Industrial illustrated the overall performance of the market in the United States. They're all gone, right? Except for GE. And now they want to kick it off, the Dow, because it's not performing, right? It's not performing. So get rid of the losers, throw in a winner, and that's why the Dow will always go up, right? It's always skewed to go up. But what does an index mean? He talks about, my friend, this DXY, it's just an arbitrary number. The Dow, it's just an arbitrary number if you just keep reshuffling the deck, okay? Is anybody waiting for American cotton to come back? Is anybody waiting for American tobacco to come back? Is anybody waiting for Tennessee Coal and Iron? No. So GE, the last of the original Dow stocks, they want to kick out. It's unbelievable, people. It's really shameful. Anyway, that's it. Beautiful day out there today. Gorgeous sunshine. Weather is moderate. If you can get out, take a walk. You know, do you good. But I think right now, people, we're really at a point where things are going to break one way or the other. It's going to be interesting. Anyway, that's it. Lord willing, we pick it up tomorrow. Ciao.